So let's go straight, to this question of Mudarba solution that we have developed. The challenge that we were, facing is that there is, the growth of Islamic finance is significant. However, Islamic banks are, mainly relying on murabha, stroke tawarruk type of, or commodity murabha type of, solutions to avoid certain risks that are associated mainly with mudarba and musharaka, and also to some degree with wakala, right? As Edward has rightly said, that murabha is a very straightforward sale contract. There's, it's very Sharia compliant. There's no problem at all with that. However, when it's used in a certain way, especially in tawarruk or in reverse murabha or in commodity murabha, there's different names, then its spirit and its compliance with Sharia becomes, pretty controversial, also questionable, and some people, they start getting irritated with that. However, due to the certain limitations that the industry has faced over the the last 2-3 decades of its fast growth, the banks are usually trying to do murabha. This is something that they find very close to their the conventional products of fixed rate return. So that's why they are trying to do that. Right. So the products that they need to be Sharia compliant by spirit, also fulfilling client needs, and they have to be market competitive and profitable for everybody. So we are trying to develop products that are based on mudarba, musharaka, and wakala instead of murabha. So we are not saying that murabha is not good, but we have to move on. We have to go to the next level. Hence, we have worked on this mudarba. Now, let me give you a brief background of the issues with traditional mudarba. It's a partnership agreement whereby one party provides the capital, who is called Rabb al-Mal, and the other party provides the labor or the work or the expertise, who is called mudarib. Now this is, this type of contract is very much preferred from Sharia point of view, because the majority of the scholars, they believe that this is, the true spirit of Islamic Sharia. However, it has, major issues that make, the banks reluctant to use it. And what are they? We have grouped them in 3 groups, yeah? So the first one is actually the moral hazard. There's a lot of, possibility or probability, I would say, a high probability of, having fraud or falsified financial disclosures, right? Because the bank or the financial institution is providing, the finance, the capital solely, and the client is actually just providing, or they're deploying the funds, right? So they do not have any financial, input into the structure. Hence, the possibility of committing fraud or trying to trick the bankers by falsified financial disclosures, or having 2-3 different sets of books. The one they will present to the taxman, the other one they will present to the bank, and the third one they will have for themselves. This is very high, and I feel sad to say, but unfortunately this has been observed in Islamic financial industry as well. I tell you, a few years ago, I think at least 6-7 years ago, we tested the first mudarba here in London with an Islamic investment bank who is our client, and we had to really struggle for about a couple of years to convince the bank to go down the mudarba route and test it at least once. And the first trial that they did after a lot of persuasion from our side, it was a high street retailer, very good business. I think the transaction took place in 2008. Unfortunately, the recession kicked in, or a few months later. But then, besides the impact of the recession, we observed also some issues coming up from the client as well. For example, their cost of running business started going up. The salaries were multiplied by X. The expenses were multiplied by Y. The income was divided by Z. So we don't know what's going on, and before actually the bank can realize, suddenly the customer has presented a balance sheet to them, an account, that they have made a loss, and the bank as Rabb al-Mal has no choice but to accept the loss. So this opened our eye that actually there is a problem here, and that was more of moral hazard and less they just they used the excuse of the recession to create this problem. The other set of problem, we call it agency problems, which is when you have the money coming from somewhere else and you do not have any financial stake in that. People tend to have, make, they usually become more aggressive in their risk taking. So they will start doing things that they will not do otherwise if their own money is involved in it, right? And also, they start making uninformed decisions. So, okay, now I've got the money, let me invest in this, let me invest in that, or, they will probably not make due diligence in buying, the equipment that they need, or, the services that they are providing, and so on and so forth. So this also is, an inherent problem observed within Mudarba. And the third one is the adverse selection, which is, Mudarba by definition is a profit-sharing instrument. But the clients, sometimes they see it as a loss-sharing instrument, right? So when somebody is anticipating a loss, right? So what they will do, if they are making, profit, what they will do, they will go to the conventional side and, get a fixed rated return because they know, okay, this is what I'm going to do. But when they are anticipating a loss, they will go to, the Islamic Bank and they will, try to get a Mudarba, because they know that having Mudarba, they will be actually able to share the losses with the bank. So, this is actually not the genuine client that the bank is looking for, and hence the bank is facing this issue of adverse selection, and they have to be really very careful and very vigilant in what they do and how they select their clients. So these are the major problems within Mudarba. Nothing related to Mudarba. It's just the modern day practice that has actually become an issue. There are clear IOFI Sharia standards around Mudarba and other things as well. So what we have done from here, and after the experience of burning our hands in London, we developed this new solution, which actually is not, don't think that we have reinvented the wheel of Mudarba, or we have been very innovative in creating something out of Mudarba. No, Mudarba is a very simple, straightforward instrument, and it has very strict connotations, so we actually cannot go beyond those boundaries. But what we have done, actually, we have looked critically that what are the these three issues that are coming and how can we control them. So the solution actually is not reinventing Mudarba, but the solution is actually finding the controls that we have put around this Mudarba to make sure that these risks are managed in a very strict manner, and we stop these losses, and we manage these risks proactively. So this is truly Sharia compliant. I'm sorry, there is a little typo here. It's not fixable, but it's actually flexible. Okay, it allows the client to utilize any amount of funds up to the agreed limit. So there will be an agreed limit that the bank will provide to the client. That will be called Mudarba capital. So they can use any. So it's entirely at their discretion. They want to use it in the morning, and they want to repay in the afternoon or next day, or in 1 week time or whatever, and so on and so forth. So they can use it as working capital, or they can also use it as overdraft. The risks are reduced because of the set of control functions that have been implied in this solution, and there is an improved protection in this structure. It's very efficient because instead of going down the Murabha way, the traditional way, where the banks have to buy and sell the assets, and there are so many contracts flying around, and the questions of ownership, and it's very onerous process, and it's very costly as well. So applying this Mudarba structure, the transactional cost is reduced to really minimal, and it becomes very flexible in these different uses. There are certain limitations also, which I want to tell you right now. The solution that I'm presenting here is mainly for the businesses, and for those businesses who are established, have a track record already, and they have some at least a reasonable I would say accounting structure in place, so that we can see their performance and how they are doing. So this is not for individuals. This cannot be used for personal overdraft, etc. And it cannot be used for new businesses, because there won't be any track record, if you want, or very small businesses where there is no accountancy or sole tradership, etc. So it's for medium to large size enterprise, where there is a track record of business and there is a reasonable accountancy. So how the process is going to work? The client will approach the bank. So in stage one, the client and the bank, obviously having their, credit checking and due diligence, etc., they will agree on the first of all the limit of the facility that the bank will be providing to them, and then they will also agree on the profit sharing ratio, because in Mudarba you cannot determine or you cannot guarantee you can neither guarantee the capital nor you can guarantee the rate of return. Instead, there will be a profit sharing ratio that, inherently Mudarba is a profit sharing instrument. So when two parties come together, the bank and the client, the objective of this union is actually to generate profit, right? So we are assuming that there will be a profit. It will be divided between both parties, between the bank and the customer, by a certain ratio. It could be 50-50, it could be 80-20, or whatever they agree between them. And they will also agree on the expected profit rate, as there is no guaranteed return on this. So we can only have an expected profit rate. For example, the bank will say, our expected profit rate, we expect this Mudarba to pay us like 5%. If we get 5% return, we are happy with that. Now the facility is made available to the client. So basically it's sitting on the system. The client can use the bank's funds within the facility as and when required to the limit. Then the bank will, and as I said, it's like an accordion, so it can work any way, anytime. The bank will send a monthly statement to the client showing the amount of the Mudarba capital. This is the limit of the facility that's provided, utilized in the month, and the advance profit payment that's payable by the client for the relevant month. Now what is happening is that we are asking the client actually to pay the expected profit rate in advance, right? Because in those who don't know Mudarba very well, if it's for a period of 1 year, for example, so the final accounts have to be made, the final calculation will be made by the end of the the Mudarba term, so by the maturity of the instrument. Then we will see whether there is a profit or there is a loss. But here what we are doing is, and according to AYOFI Sharia standards, we are allowed to ask the client to pay us advance profit, and that will be on account. So it means that the customer is paying the bank 5%, for example, the expected profit rate, but this will remain accounted and it's on account. By the end of the year, there will be a final account made. If there is 5% profit, then the bank will keep the profit. If there is not 5%, if the profit was 4%, then the bank has to return 1% to the client. But there will be a monthly statement that you have your limit is, say for example, £50,000. You have in 1 month you have utilized £30,000. This is the calculation for that, and your expected profit that you have to pay us this month is, say, £500. Okay. The client makes the monthly advance profit payments on the relevant payment date, and the client sends his quarterly management account and a confirmation of the achievability and of the expected profit rate based on current business performance. Now again, this is very important. What we have done here is we have contractually obliged the client to send us a quarterly management account, and that's why it's important that they have an accounting structure. Otherwise, we won't be able to have this information, and we don't really need a lot of figures coming from them. We don't really need a full balance sheet every 3 months. We just want like 4 or 5 headline figures. This is the turnover, this is the cost of sales, this is the gross profit rate, etc., and so on. So like 4 or 5 figures they have to submit every quarter or every month, depending on what's the arrangement between them.
3 books. Which book is this coming from?
Good question. We'll come back to that. We'll come back to that. The question will be answered within the presentation. And we also need to, when they submit the account, when they submit the management account, they also have to put just one line, right, stating that they are achieving, the expected profit rate, and for the next term they also anticipate, to achieve the same. So it's not an undertaking from them, but it's just an indication that they are performing and they're not running into loss. Okay, this is all proactive approach to make sure that before the client starts making loss, we can actually stop them, right? And how we are going to stop them, I'll tell you also. But before we go to that stage, let's talk about the profit calculation, which is you may find it a bit complicated, but actually it's not. So the profit will be calculated in 3 stages here, right? What will happen is, in the first instance, say for example the facility limit that was granted from the bank to the client was £40,000. Okay, you have dollars here, but just read them pounds. And the Mudarba profit sharing ratio is 99% for the bank and 1% for the customer. Now this is something that's arguable. People can say it's too much, etc. But you will come to know actually that why we push it to the max. So 1% for the client and 99% for the bank if there is a profit. However, the bank is expecting a profit rate of 5%, right? The client capital is also, because this is the money that's going into the client's existing business, right? This business is already existing. They already have their assets, right? Those assets are already deployed in the business and they're already generating profit. So this is very important, and all this will be part of the contractual agreement, that we will take their the client capital also into account, and for this purpose we allow only the current assets, okay, not the fixed asset. The current asset will include cash and inventory, okay, nothing else. So that will be included, that will be construed as current asset, and that will be used as in the contract, that will be construed as the client capital. Now what will happen is that if the customer has drawn down in the month £30,000 out of 40, and if their own capital was £70,000, so the total business, the total Mudarba, the value of the Mudarba has become 70,000 plus 30,000, that's 100,000, okay? And the business gross profit for that period is £10,000. That's the gross profit, right? So how we'll calculate here is that the total capital of the Mudarba itself is 100,000, and out of that 30,000 is provided by the bank as Rabbul Mal, and 70,000 is provided by the client. That's their own capital, client's capital. The gross profit of 10,000 will be now split according to the share of the capital ratio. First of all, in the capital ratio, this is the stage 1. So capital ratio is 30 and 70. So what will happen now? The client's share of the gross profit will be 7,000, as it's reflecting the share capital, the capital of the client, and the Mudarba profit, the total Mudarba profit will be 3,000, because the Mudarba capital used in the period was 30,000. Okay. Now we have got the Mudarba profit, and this is £3,000. The Mudarba profit will be now split into the two according to the ratio, which was 99% for the bank and 1% for the customer. So as a result, now from this Mudarba profit, the client's share will be only £30, and the bank's share of the Mudarba profit will be £2,970. Okay. Now we go to the to stage 3, and this is very, very important here again, because we have introduced some new things here. Now the bank's share of the Mudarba profit is £2,970, which is way above than the 5% profit rate, expected profit rate. Okay. So what we do now, that if we start drawing all this money from the client, the product will become absolutely unviable. It's not going to work. It will be very, very expensive, and nobody will be able actually to afford this product. So what we do, 2 things. We create a profit stabilization reserve, right? So we create a reserve, and this is again contractual, that the expected profit rate will be, if we take the expected profit rate of 5% for a capital of £30,000, for this period the amount should be 1,500, not 2,970, right? So what we do is that we pay, the client pays £1,500 to the bank as the expected profit rate on account, okay, subject to final settlement by the end of the period. The rest of the money of the 2,970, what we will do is we will put that money into the profit reserve. And what is this profit reserve? We leave this money, the remaining money of 1,470, we leave it with the customer. So the customer keeps this money, right? And again, contractually, the customer will have the discretion of using the money as they want. Okay, if they want to, deploy it in the business, that's their own decision. They want to do that at their own risk. So it has to be construed as qard or a zero rate loan if you want. So they are taking the risk of it. They can use this money, but it has to be accounted, on the side that this money remains the right of the bank. Okay, but we are not taking it. We are just leaving it with them. And this reserve will actually become a twofold thing. First of all, it will start creating a reserve for like it's like a pot that the bank will create for itself, and the customer will be holding that money for the bank. Again, they're not paying out that money. They're keeping that money accounted, and they can continue using that money. But this will allow the bank, if the expected profit rate falls more less than 5%, they can actually make use of this money that will be sitting in the reserve. So there will be a call option for the bank. They can call the entire amount of the reserve or part of the reserve. They can call at any time to make if there is a shortfall in the expected profit rate, so they can make use of it. And the other thing is that then the customer will now have the obligation of paying this to the bank if if there is any issue or if there are any losses to the customer's business, then they have to pay this money. And this will be as a priority over the other debts that the customer will have. Right. So the controls that we have put in place around this structure. First of all, there is a very strict eligibility criteria. So the customer should be an existing business with track record, must have an accountancy system, must have good past financial performance, and must have projected accounts. Okay, to make sure that we are not giving money to just anybody. Then there will be an ongoing monitoring, meaning there will be quarterly accounts that will be completed by the client and they will be reviewed by the bank, right? Then there will be a stream of monthly income. So unlike the majority of the mudarbas as they are or musharkas as they are construed usually by people that we have to wait till the maturity and then we'll have a lump sum of money coming out, we have actually provided for an advance profit payment that's paid on a monthly basis that provides a constant stream of income to the bank, and it remains on account. So if there is a settlement to be made, that will be made by the end of the year. But with this profit equalization reserve, it's actually very unlikely that there will be any major fluctuation in that. Also, there is a control to reduce the potential loss, which is contractually we will put the client under obligation that they cannot sell their goods or services below their cost. So they can only sell, this is a contractual obligation for the customer, that they can sell their goods and services only above the cost, right? And this is very critical because that's where the majority of the fraud and majority of the moral hazard lies, right? People will artificially increase their expenses, or they will unnecessarily or unduly they will decrease their prices, and they will start selling below their cost, right? So what we do here is that we put them under contractual obligation that they can sell only above their cost and not less than cost. Now, we also understand that in some businesses it may happen, for example, in perishable goods or in seasonal, type of business where the goods, for example, have to be sold, and they have to be liquidated. So in that case, what we ask the client, again, it will be a clause in the contract that they have to seek permission, or they have to at least inform the bank that they are going to sell a certain amount of stock under the cost, and this is the reason. So if there is a valid reason, for example, destockage of a certain perishable good, or destockage of a seasonal, a fashion line or something, then of course that's possible. But otherwise, generally speaking, they cannot sell less than their cost. And the next one is that the profit calculation is strictly based on gross profit and not from the net profit. And why we say that? Because when you take the turnover and you deduct the cost of sales, that's it. All the fixed asset and the fixed costs, etc., will be actually left for the customer. They have to deal with it, and this is how we stop the door actually of this moral hazard again. We do not allow them to manipulate their accounts. So it's technically very difficult for them to manipulate the accounts and to commit any fraud or any gross misconduct here. And then there is the final calculation with the profit reserve amount that can help in stabilizing the profit payment and offset the capital losses as well. Now what happens is that this profit reserve that we have created is not forever, right? So it's not something eternal. But what we do is that we keep this profit reserve. We put a cap on that profit reserve. So say, for example, if it has reached like 20% of the finance facility, and that will entirely depend on the risk parameters of the bank itself, whatever they want to do. And so once that level is achieved, or if the client actually does not wish to continue, and they want to terminate the facility, and if they have continuously paid the expected profit rate as agreed, then we forego, although the money actually belongs to the bank, but what we do, we give it to them as a gift, as an incentive for good performance, right? So in the end, the expected profit rate that was paid is the profit rate that the bank will receive finally. They keep themselves protected throughout the life cycle of the instrument of the transaction, and the customer is not paying out the money. However, this money will be accounted. It will remain there for the throughout the life cycle of the transaction. It will be used only if there is an issue. Otherwise, in the end, it will go back to the customer, and we terminate the transaction. If the customer wants to renew, we can continue with the same reserve, right? So this, we believe, actually is Sharia compliant, commercially viable, and practical solution. From a risk management point of view, what we have done here, three things: contractual obligation of not selling the goods and services for a price less than the cost without written prior permission of the Rabb al-Mal. That minimizes fraud, moral hazard, and agency issues. The calculation of Mudarba profit from gross profit, that's turnover minus cost of sales instead of net profit, again minimizes the issue of fraud, moral hazard, and agency issues. And the creation of a profit reserve for the Rabb al-Mal, that's the difference between total Mudarba profit and the expected profit paid by the Mudarib, for the benefit of Rabb al-Mal, and to be used only in case of loss, or top up the profit to achieve the expected rate. That provides protection also to the bank or to the Rabb al-Mal. And this solution can be used not only in Mudarba, but actually these controls can be added to any sort of transaction. That's the reality. So you can do a musharaka, you can do a wakala also for using these parameters. Very quickly, the benefits for the customer and the bank. For customer, it's very convenient. It's an agreed facility available for utilization as and when required. Very flexible. So it's not only financing a certain equipment, or financing or buying and selling assets and so on and so forth. You can actually put funds at their disposal that they can use for anything in their business, even for paying salaries, for paying rent, for whatever. It's very easy, no complex procedures to follow. The reality is actually that we are saying that they need to submit the accounts on a quarterly or a monthly basis. It's just 4 or 5 headline figures. The bank has to review, and we have actually developed a tool as well, a spreadsheet. You use that, and usually you need only around 15 minutes per month to manage one client. So it's very, very lean management, and it's very competitive also, because with this you can actually be very competitive with the conventional market, and you also get rid of all the the onerous transactional cost of murabahas and tabarruks and so on. For the bank, it's the risk profile is much more moderate than the classic mudaraba, if you want, because of this enhanced monitoring mechanism. There is additional protection for them because of the profit reserve amount that we have put in place. There is regular income for them, so they don't have to wait till the maturity. They are receiving advanced profit on monthly basis, and it's very efficient because the transactional cost is very low. Now the implementation of this product, we received the award last November, but then after that we have actually implemented this in a few banks already. The product has received the Sharia approval from Abu Dhabi Islamic Bank in the UAE, from also Bank Dhofar, from the Sharia boards, and also the largest Islamic bank in Sudan as well. Currently, it's launched in Oman. That was actually our first client in Oman, and you won't be surprised that within the first week, within the first 5 days of business, they had their book was $7 million approximately just for this product. And we also used it as a working capital finance for micro businesses for Islamic Relief Microfinance Program in Palestine as well. Although I'm saying this majority is mainly for corporate and medium-sized businesses, but then again I am running out of time, so I won't be able to explain to you how we have actually implemented on microfinance also. But this is a pilot that we are running currently in Palestine as well. I think that's it pretty much. So thank you very much for your time, and I'm happy to take your questions.
We're going to have a few questions.